easy to understand.
I know only Hindi and English, sir. Okay, so let's start. Today we are taking up Shri Loan Protect. Shri Loan Protect is a product which provides a combination of coverage. I think some of you must be selling this policy because this is not a new policy. In fact, this is provided to the loanee, to the financiers, because servicing a loan is a long-term commitment for the customer. It's a planned outflow, you can say. When it's a planned outflow, certain unexpected events can derail the plan. So in that case, loanee as well as financer, both are derailed. So they both need the coverage. If the loan protect coverage is there, that means loanee, in case of any unexpected events, will be ready to face the consequences. Because the unexpected events means accidents, critical illness, damage to home. And these things may result into the death, disability, reduced earnings. So the person who is already under loan, how he will face these things? Unless he has got some financial support. And on the contrary, if a loanee is not capable to pay the loan, in that case, financier suffers the loan default and higher NPA. So to protect the interest of both, there is a policy called Shri Loan Protect. Let's see what this policy is. This one is Shri Loan Protect, which will protect both loanee and the financer as well. Because financer is also losing his NPA. Now what is NPA? You have to understand first. NPA means non-performing assets. Reserve Bank of India defines non-performing assets in India as any advance or loan that is overdue for more than 90 days. That means an asset becomes non-performing when it ceases to generate income for the bank. If the loan is given to earn the interest. But if the installment is not paid, how the interest will come? Then it will become non-performing assets. A loan is classified as a non-performing asset when it is not being repaid by the borrower. In such a case, the loan is considered as in arrears. It may or may not come. So for that time being, till it is not received by the bank, it becomes NPA, non-performing assets. So the financer also losing his interest. But when the loan protect cover is there, it will protect or it will safeguard the interest of both the parties, loanee as well as financer. Because loanee will become liability free. He has to make no reduction in his savings and he will have the peace of mind. Similarly, the financer will face no reduction in NPA. He will feel his customer is satisfied and he will simultaneously get his additional fee income. So this is a win-win situation for both the parties, that is loanee and financer, if they are getting a loan protect insurance policy. Now this policy is a blended combo. Blended combo in the sense this provides security loan, and secure homes. Whatever loan is given, so that loan will be protected, and in addition, certain other coverages are also there. That means, in case any accident, any critical illness, any loss of job or loss of profession is there, so the customer will not be definitely in a position to repay the loan. In that case, this policy will help him. Because disbursement of loan means income to the financier. And if his loan book is not protected, there is no seamless process. There is no comprehensive protection. Because loanee's risk cover is required as per the financier's requirement. And loanee's risk cover is only this Shri Loan Protect insurance policy. So how this policy will function? Let's see. First of all, to whom this policy can be given? So the eligibility criteria is this product may be obtained by any Indian citizen, financial institution and banks. Means Indian citizen who has taken the loan, financial institution maybe other than bank, and bank as well. The age limit required for this policy is minimum 18 years and maximum 65 years. So the insured should have attained the age of at least 18 years and shall not have completed the age of 65 years on the date of commencement of this policy period as applicable. Duration of cover provides three different options. This policy can be given for 1 year, for 2 years and for 3 years. Highest sum insured is 3 crore, but as per the discretion of the underwriter. Because it depends upon the various factors to whom the 3 crores cover can be given. So this is the eligibility criteria. Any Indian citizen, any financial institution, any bank can take it. If a person is taking, he must be at least 18 years of age and not more than 65 years of age. Policy can be selected in 3 different periods: 1 year, 2 years and 3 years. Now, what is the product construct? What does policy covers? So 3 different coverages are there in the policy and 2 different plans are there. Listen attentively. 3 different coverages and 2 different plans. So first cover is personal accident and child care allowance. 2 plans are there, plan A and plan B. And in both the plans, all these 3 risks are covered. Then you may ask, what is the difference? Why these 2 plans are there? So the purpose is, plan A can be given at the time of inception of the loan amount. Plan B can be given even at the midterm of the loan. So these 2 different stages are there. Suppose I have already taken a bank loan and after 3 years I am asking you the policy. You say, yes, we have got a loan product policy, we will provide you. So my 3 years I have already gone, I am regularly paying installments, but still, for next 7 years, suppose I have taken a 10 years loan. So for the protection of next 7 years, I would definitely like to have a policy. So in that case, I will get the plan B, that is for outstanding loan amount. If at the time of taking the loan, I am taking the policy, that in that case, I will get plan A, that is the total loan amount at the inception is covered. 2 different plans. three different categories of risk. All three categories of risk are covered in both the plans. The material point is the time factor. Plan A will start the risk from the day one of the loan. Plan B will start the risk from the day the policy is given. So out of the three different categories of benefits, first one is personal accident and child care allowance. Second one is loss of employment, loss of earning for professionals and business people. This is a coverage which we have given. Normally, no general insurance company is providing this kind of coverage. Loss of employment or loss of earning. Employment for those who are employees of any organization, maybe government organization, private organization, unorganized sector. And loss of earning for those who are professionals, like advocates, doctors, chartered accountants, sport persons, like that. So the loss of employment and loss of earning is category 2 of the benefits. Category 3 is critical illness. So three categories of benefits are there: personal accident and child care allowance, loss of employment, loss of earning for professionals, and critical illness. In both the plans, plan A and B, these three benefits are covered. The only difference is, suppose the personal accident and child care allowance section is there, this will start in plan A from the inception, and plan B from the midterm of the loan. Similarly, loss of employment or loss of earning, this is covered by in plan A for maximum 3 EMIs per year. Similarly, in plan B, maximum of 3 EMIs per year. Third benefit is critical illness. Critical illness means total loan amount at the inception is covered in plan A, but outstanding loan amount is covered only in plan B. So the product construct is most important part of the policy. If you understood this aspect, then you can very easily explain to your prospective customer that what is the coverage under the policy, what are the plans under the policy, what are the category of benefits are covered under this policy. So this is most important aspect to understand, because this will explain the entire policy. I repeat, two plans are there, plan A and plan B. Plan A is given with the disbursement of loan. Plan B is given when the loan is outstanding. Three categories of benefits are covered: personal accident and child care allowance, loss of employment or loss of earning, and critical illness. Three categories of benefits are common in both the plan. Only difference is time factor.
Sorry to interrupt you, sir. Srikanth here.
Time factor is the difference, because plan A will cover the risk from the inception, while plan B will cover the risk only from the date of taking the policy. Maybe it is taken after 2 years of taking the loan, 3 years of taking the loan, whatever is the current situation.
Sir, sorry to interrupt you, sir. Srikanth here.
Yes.
Sir, what do you mean by total loan amount at the inception and outstanding loan amount?
Yes. If I am taking a loan of 10 lakh rupees today, at the same time I am taking Sri Loan Protect, my policy will protect the total loan amount. Claim will be for 3 EMIs only. but the total amount is under the coverage. But when the policy is given at the midterm of the loan amount, then only the outstanding loan amount is covered. Maybe that is 1 lakh only or 2 lakh only. So as far as the loan amount is concerned, the insurance company will pay only the 3 MIs per year. But the entire loan amount at the inception will be covered, means for personal accident coverage, for critical illness coverage, the amount will stand as per plans only. I'll take you to the detail of the coverage. See, the section critical illness. Now, section critical illness says that the risk is covered of the any critical illness provided it is diagnosed during the policy period, and the loan is undergoing for the first time of the following surgical procedures. An occurrence for the first time of the medical event has taken place. Before taking the policy, this critical illness was not there. After taking the policy only, this has been diagnosed. As far as personal accident and child care allowance is concerned, if the death of the insured person on account of an accident is there during the policy period, this is covered. Permanent total disablement on account of an accident resulting in inability to remain gainfully employed is there, still it is covered. Simultaneously, child care allowance available only if the schedule shows insured person opted for it. And the allowance will be payable to dependent children for continuing their education, limited to first 2 children below the age of 21 years. If one of them is 22 years, they will not get the allowance. So PA cover with child care allowance is there. And the third category is loss of job and loss of earning. Loss of job means loss of employment. Employer rules and regulations, if have decided closure of a division or a department on account of poor financial health, or have decided to terminate or dismiss or lay off or temporarily suspend or retrench the employees, in that case the risk is covered. Similarly, if a professional who suffered a serious injury making insured person immobile, or a professional who suffered a loss or damage to working place due to fire and allied perils, or a professional who has suffered due to inability to access work to his working place, that risk is also covered and policy will pay the amount. Now, how the critical illness will be insured under the policy? So this category of benefit is available for all loanees under both the plan A and B. But for what cover? Any individual who falls below the age of 40 is eligible for maximum sum insured. Also will cover the risk of critical illness till 65 years of age. Even if a person of 64 years is taking the policy, his critical illness is also covered. But the sum insured will differ, because the highest sum insured is given for the person who is in the band of 40 to 45 years. So the restricted maximum sum insured for the higher age band are as follows. क्या? 40 to 45 years up to 50 lakh. 46 to 50 years up to 25 lakh. 51 to 55 years up to 10 lakh only, and even above. So the person is at 40 years and above is subject to pre-medical examination. Above 40 years, the company shall reimburse rupees 50% of the cost of such medical examination fee, as the proposal has accepted. person who is less than 40 years, he don't need any medical examination. So this is a critical benefit where this sum insured will vary according to the age of the loanee. Lower is the age, higher the sum insured of critical illness. Higher is the age, lower is the sum insured of the critical illness. Critical illness is in India curable, and the results are very good. The number of people likely to suffer are very high. But at the same time, the number of people who have been cured is very good. Because the survival rate is up to 76%. So critical illnesses are curable in India. Any kind of critical illness, up to cancer. So why there is a need for this cover? That based on survival. Because survival post a critical illness impacts on the following ways. Means that there is a critical illness and still the patient or the loanee has survived. The patient has to dip into his savings to fund the treatment expenses. Secondly, the earning capacity of the patient reduces. In that case, this policy will help, because people often believe that life insurance cover would be sufficient for their need. But life insurance policy does not pay in case of critical illness. Life insurance pays only on two occasions. Either the death of the insured is there, or the policy is matured. Or in between, if there is any survival benefit, means terminal endowment policy is there, then the amount and piecemeal can be given. Otherwise, the total amount is paid either on the death or on the maturity of the policy. So life insurance will not cover this risk. Life risk insurance will only kick on the death. So it is imperative that the customer must cover himself against the critical illness. Under this policy, we cover 10 types of critical illnesses. And these 10 critical illnesses are the most popular in the sense they are very common in Indian masses. 10 critical illnesses are cancer of specified severity, myocardial infarction related to heart, first heart attack of specific severity, open chest CABG. CABG means coronary artery bypass grafting. In short, what you call it is bypass surgery. So this CABG is a coronary artery bypass grafting. Open heart replacement or repair of heart valves, kidney failure requiring regular dialysis, stroke resulting in permanent symptoms, major organ or bone marrow transplant, permanent paralysis of limbs, multiple surgeries with persisting symptoms, and primary idiopathic pulmonary hypertension. These are the 10 critical illnesses which are covered as a category of benefit under this loan protect policy. Now, another section is personal accident. So under the personal accident, only two risk coverages are given: accidental death and permanent total disability. And in both the cases, the 100% sum insured of the PA cover is paid. So the policy will pay to the nominee in case of death. 100% of the sum insured under the schedule. And under permanent total disability, again 100% of the sum insured, but this claim will be paid to the insured himself because he survived. And this permanent total disability may be in various permutation combinations. Say suppose a person has lost two legs, or lost 2 limbs, or 2 eyes, 2 hands, or in different combination like 1 hand, 1 leg, 1 eye, 1 hand, one eye, one leg. So, not many combinations are there. In that case, if the doctor certifies that the 100% permanent total disability is there, insurance company will have to pay the sum insured of the personal accident coverage. But the personal accident coverage is given on the basis of occupation. Because on the basis of occupation, there are 3 risk categories under personal accident policy. Risk group 1, that is low risk, risk group 2, that is medium risk, and risk group 3, that is heavy risk. So these 3 groups will decide the premium rate. Under risk group 1, where the low risk is there, the person who are not supposed to meet with an accident frequently are there, because the low risk opportunities are there. People who are sitting in the offices like accountant, doctors, lawyers, architects, consulting engineer, teachers, bankers, they are sitting in the safe places, very hygienic as well as safe environment. So the risk of accident is not there. But in second category, where the medium risk is there are people who are working in the field, like veterinary doctors, drivers, motor mechanics, professional athletes, sportsmen. They are the people who are working in the field, so the chances of accidents are little higher. This is called medium risk. The third category is heavy risk. But the persons working in underground mines, explosive magazines, and workers involved in the electrical installations with high territorial supply, a high tension supply, jockey, circus personnel, mountaineer, winter sports player, skiing, hand gliders, river rafters, polo players. They are engaged in very risky, very high risk professions. So obviously their premium rate has to be high because the heavy risk is involved. So when the PA cover is given, simultaneously child care allowance is also covered. Now child care allowance will be given in case of death or permanent total disability of the insured for his 2 dependent children. But both must be less than 25 years of age. And the total sum payable is 2% of the sum insured under the section of personal accident. So these are the 3 benefits: critical illness, personal accident, and now coming to the loss of employment. Loss of employment means loss of job, loss of earning. Loss of job could be because of the termination of the employee, closure of the office, shutting down of the office, retrenchment, layoff, temporary suspension, dismissal. These all activities are done by the employers. If the employer is doing that, that means the loanee or the employee can lose the job. Even voluntary, compulsory retirement is an employer's job. But the situation will differ whether the employee has opted for voluntary retirement or he has resigned. Because in that case, he has not lost the job. He has given up the job voluntarily. So resignation, superannuation, early retirement are not the reasons of loss of job. Similarly, loss of earning. Loss of earning is where the professionals are there. Professional means doctors, chartered accountants, advocates, investigators, professional players who are not in any kind of employment. If they are not able to move from the bed, they will not earn. If they have suffered loss or damage to working place due to fire and allied perils, they are not in a position to earn. If their working place is not accessible due to any reason, maybe road is blocked, flood is there, riots are there, or long-term curfew is involved, so any such reason will stop it. So these three risk categories are covered in the process policy. Now there is a process outlay. Process outlay defines at what stage you should give the policy to a person who is taking the loan from any financial institution or a bank. How the customer onboarding will be there. So process outlay will define it. Process outlay says at the first stage, when the sales interface is there, customer applies for the loan from the financial institution. Then the credit team of the financial institution or the bank sanctions the loan. After inquiries and verification of documents, the credit team sanctions the loan. So the sales team of financial institution goes to the customer for docket signing with the sales team. So a lot of papers have to be signed by the loanee before getting the disbursement, loan disbursement. Then at that stage, when the papers are signed, if the Treasury Loan Protect proposal form is there and it is attached to the loan docket, the customer will sign that document also, because it is from the financial side. It is to protect the loan amount, to keep both the sides happy, loaner as well as financier. So the proposal form has to be pitched while the docket is signed. Customer agrees and signs the proposal form. In that case, the loan is disbursed. When the loan is disbursed, the proposal and premium checks is collected by the sales team from financial institution and given to the person. And companies, insurance company, in Excel format will get the detail. So the amount of premium is also deducted. If it is confirmed the loan, the premium amount has been deducted, a policy is issued within 1 or 2 days. That means outlay process says that when the sales interface is there, customer is applying for the loan, credit team is sanctioning the loan, they are getting the docket signed by the customer. At that stage only, proposal form is signed by the customer. Automatically the policy is sold. So this says the process outlay of customer onboarding. Now, the process will be automatic and this will be favorable to both customer as well as the financier. The salient features is value for money rates so as to put minimum burden of insurance premium on the clients, regular EMIs. A regular revenue model for the finance company is there because the interest will be earned from the loan amount with the freeness of mind because the policy is there. So keep the insured and his family as well as the financier very free from the calamities on the assets and the survival of the issue. Now, the customer may ask why Shriram? Why you are taking a policy from Shriram only? There are reasons. Because Shriram is a renowned name with a proven track record across industries. SMS facility for sending policy renewal reminders, policy issuance status to the client is already there. Business figures are sent to the channel partners via automail on daily basis. All MIS via automated email system at predetermined frequency to channel partners is convertible to MS Excel format for analysis. Business done by branch, product wise and relationship managers wise breakup is there. And largest branch network is there with the biggest sales force. So these are the points giving strength to you for selling your product. Secondly, infrastructural support is there. One national coordinator dedicated to handle the relationship is there. A state-wise dedicated member for business support is there. Matrix support structure involving local branch and head office ensuring best efforts claim servicing is there. Flat structure, no claim file will travel more than 2 hands. So claim settling will be smooth. Now, this is one good thing that your company is in tie-up with the following partners: Aavas Housing Finance, Hinduja Land Housing Finance, India Home Loans, DMI Housing Finance, Shriram Housing Finance, Supreme Housing Finance, and Indexia Home Finance. To these financial institutions, you can give your loan protect proposal form. Their sales team will pitch the loan amount whenever any loan is coming, and when he is signing the docket for the loan papers, at the same time your proposal form will be signed by him and the amount will be paid to the insurance company of the premium. So you can avail this facility. You can contact with these institutions personally so that you can get direct help and direct premium from them. Now, how the premium will be decided? So the premium formula is basic rate into sum insured minus discount for all these 3 things. Uniform system is there. Basic rate, sum insured, and discount. Now, how this premium rate for personal accident will apply? Rate per mil is applicable for risk category 1, that is low risk, only 0.70 per thousand. Risk category 2, that is of low risk category, 0.95 per thousand. Risk category 3, that is for high risk, 1.40 per thousand. So for personal accident, on the sum insured selected, this premium rate will apply. So the PA cover will be rated like this. Secondly, loss of job. What is the loss of job? When the employer is removing the loanee or the employee from the job by any reason. Maybe they are shutting down the company, they are closing the division, they are retrenching the employee, they are firing the employee, there is a layoff of the employee, there is a dismissal of the employee. From the side of employer, if any such action is there, that will be treated as loss of job. To cover that risk, 50 rupees per thousand to be charged on EMI. So the loss of job or loss of earning, both are rated similarly. Loss of earning means for professionals who are not able to move, who are not able to access to their office, who are not able to earn now, There is well also be covered. And the third one is critical illness. So the premium chargeable for critical illness is according to age band. Age band starts from the 18 and it goes up to the 70 years. Though the maximum limit is 65. But suppose the person of 63 years has taken the policy and he is renewing the policy, then for next also, for one bar also, the premium rate will be charged. So 18 to 5, 26 to 30, like that, 5 years age band is there. Premium starts from 1.83 per milli per thousand. And the critical illness will be treated when 1 out of the 10 critical illnesses which are covered under the policy is suffered by the loanee during the policy period, diagnosed during the policy period. There was no such critical illness to him earlier. This was the first diagnosis during the policy period only. Now the policy also provides for the discounts. Two different discounts are there. And the discount criteria as per the size of group is there. If the group size to whom you are giving this policy is less than 200, then you can give 2% discount. The size will decide the discount rate. Up to 300, 4% discount, up to 456% discount, and up to 450 or above 8%. So this is group size discount. Second discount is for the policy tenure. If policy is taken for 1 year, no discount. If it is for 2 years, 3% discount is there. If it is for 3 years, 6% discount is there. So that you can give on the face of the policy itself. Now, to whom this policy you can say? This is important to understand. Because any individual who took loan will be the target customer. Any person who has already taken the loan is also a target customer. Policy can be sold through financial institutions like banks and NBFC. NBFC means non-banking financial center, company or any institution who are authorized and have the license to disburse loans. Customer who avails long-term dwelling insurance can be potential customer for this policy. Long-term dwelling loans means persons who have purchased a house, taking the loan, maybe for 10 years, 15 years, 20 years, because it is taken for the residential houses. They will definitely prefer to take this policy. If they are not, their financial will prefer to take this policy. Because in such a long term, there is a possibility of happening any untoward incident, any unfortunate accident. That may be a personal accident, that may be a critical illness, that may be a loss of job, whatever kind of thing. So in such a case, this policy will be very helpful. Now, every branch has been given the underwriting guidelines with the limits, with the premium calculation, to whom the policy has to be sold. But for selling this policy, this is most important for you to understand what is the product construct. Because if you have not gone through this slide, this presentation or you have not understood the construct of the product, then you will not be in a position to sell this policy. You will find two different plans unless you have the clarity in your mind that what for the plan A is there, what for the plan B is there. That clarity has to be there. Secondly, in both the plans, the similar risk coverage is there. Thirdly, you are given a choice if requested by the insurer. If customer says, I have a separate personal accident policy, I don't need the personal accident cover. Okay, underwriter may consider that remaining two sections will be given to you. Otherwise, normally in both the plans, three sections are there. And all three sections will be automatically covered. Premium rates are very simple, very clear. But the difference in plan A and plan B has to be understood because in critical illness, say suppose, total loan amount at the inception is covered. Total loan amount. But the sum insured of the critical illness is given according to age. And the premium rate is applicable according to age band. Now suppose total loan outstanding is 10 lakh only. Person is of 35 years of age. So for he has selected the maximum sum assured for himself. Maximum sum assured for a person of 40 years or 35 years is 50 lakh. So coverage for him will be 50 lakh rupees. Premium rate will be chargeable as per the sum insured. He will be in a position to repay the loan. 3 EMIs will be covered. So that way, the sum insured of all the three sections would differ. But under both the plans, the risk categories will be the same. Two plans are there. Both plans are sellable. Different situations will decide. If the loan has already availed the loan, you cannot give him plan A. If loan has applied the loan now, you can give him the plan A only and will not give the plan B. So here your choice will not work. The situation of the loanee will work. The situation of loanee will decide which plan has to be given. So question of selection is not there. Question of situation is there. Question of selection in the category of benefits is also not there. Because these three benefits are covered under both the plans. There is also no choice. Only thing is, when these three categories are covered in both the plans, the premium rate has to be understood that how premium rate will be applied. Because premium system for all the three categories is different. In case of PA, rates will be chargeable according to the risk category of the loanee. If he is in risk category 1 and 2 and 3, that is low risk, medium risk, high risk, on that basis will be the premium rate applied. So this application of premium rate on the sum insured of the PA will be on the basis of his risk category. But this is not the case in case of loss of job or loss of earning. Here, the premium rate will be 50 rupees per million to be charged on EMI. Similarly, in critical illness, so critical illness also the premium will be different according to the age band. And the age band will start from 18 to 25 to 26 to 30, like that. for every 5 years. But the premium rate is not that high which cannot compete in the market. No way. One policy if you are selling to any of your customers, he is getting 3 different category of benefits. It means the coverage is very wide. In accidental case also his risk is covered, in critical illness also his risk is covered, in loss of job also his risk is covered. So the NP of the financer has to be protected. Their revenue should be generated on the installments deposited by the loanee regularly. If loanee is not able to deposit or repay the loan or repay his installments back, in that case, financer may lose his NPA, his financial position may deteriorate, they may close financing, they may increase the rate of interest, or some hard steps they may take. Because NPA is one thing which directly impacts the balance sheet of the financer. Directly. The more NPA amount will make the financer insolvent. Non-performing assets, which is for more than 90 days, means if 3 continuous installments are not paid, bank will put you in the NPA category, or the financer will put you in the non-NPA category. There, that will be against your goodwill. That will be against their income. You will be treated as the non-performer. They will treat your loan in arrears. They will treat your loan amount as in arrears. So NPA under no circumstances is good for any financial institution. No financial institution would prefer that NPA should increase by any manner. That is the reason they are also pressurizing the customer to take the Shri Loan Protect policy. They are also recommending, because in case you are losing the job, that is neither in your end nor in our end. But if you are losing the job, if you are losing the income, you will not be in a position to repay the loan. So that is neither good for you nor for us. Secondly, you may meet with an accident anytime, nobody knows. If you are losing your life, if you are losing your body parts, it would be difficult to repay the loan. Who will pay? Or unfortunately, if you are suffering any critical illness, which anybody can suffer at any stage, because the number of critical illnesses are there which may affect any body part of the person. Heart to body parts. Everything is susceptible to the critical illness. Age does not matter. At any age, critical illness could be there. So under all these 3 circumstances, this Shri Loan Protect policy will protect the loanee. This will keep him happy and this will keep the financer happy. So this is one policy which can be sold by you to the any Indian citizen, financial institution and bank. If you are giving it to any person, keep in mind the age must be minimum 18 and must not be more than 65. So this is the policy, and I can ask any questions if you have any doubts in your mind.